Good afternoon, good day, everybody, from wherever you are. My name is Leif Anderson, and I am a third-year law student here at the George Washington University Law School. We would like to welcome you back to day 2 of the second annual Business and Finance Law Conference hosted by GW Law. This is a very special conference because it's completely student-run, student-driven, and we have put a lot of effort and time into it. If you were here yesterday, welcome back. It's great that you chose to come back for day 2. If this is your first panel, we welcome you to the tax panel. We're glad you decided to join for this one. So the upcoming panel that we will have is about addressing issues in digital taxation, a EU and US perspective. I'm now going to turn it over to my colleague, Hannelore.
Thanks for kicking us off, Leif. My name is Hannelore. I'm an LLM student in Business and Finance Law at George Washington University. And I also work for the World Bank as a consultant on doing business and digital taxation. It's great to see all of you from all over the world. Thank you for joining us.
Before Hannelore introduces our panelists, I want to briefly speak about what you're going to hear today. The rapid growth of the digital economy has challenged long-standing precepts of taxation based on physical presence. To respond to the growth of business operating cross-border through digital means, European countries have proposed changes to their domestic tax systems, including taxes on digital services that largely affect US technology companies. Today, our panelists will discuss these proposals from the view of European nations and the US tech sector. Next, they will discuss the progress of international efforts to create uniform rules for digital taxation. And finally, we will hear from them about what lies ahead in digital taxation. Now, I turn it over to Hannelore to introduce our panelists.
Thank you, Leif. We are excited to introduce today's panelists, including experts on digital taxation from academia and the private sector. It's a great honor that we welcome our 4 international panelists who will be speaking to us about digital taxation. Please allow us to introduce our 4 panelists. Our first panelist is Ruth Mason. Ruth is Professor of Law and Taxation at the University of Virginia School of Law. Her research focuses on international and EU taxation, including she has multiple publications related to the legality issues of digital service taxes. Our second panelist is Jean-Philippe Van West. Jean-Philippe is a senior counsel international tax with PwC in Belgium and guest professor at the Free University of Brussels, as well as the author of various publications on international and EU tax law. Jean-Philippe holds a PhD on international tax from the Vienna University of Economics and Business. Our third panelist is Kimberly van Zande. Kimberly is an associate at Tiberghien Tax Lawyers and is also working at the University of Antwerp as a PhD student. Her research focuses on the taxation of artificial intelligence in the international, European, and Belgian context. And lastly, Gary Sprague is partner at Baker & McKenzie in Palo Alto in California. The focus of his practice includes tax planning and advice, tax controversies, transfer price planning, and tax policy for software, high-tech, and digital enterprise companies. Gary was one of 5 business representatives selected by the OECD to participate in the OECD Technical Advisory Group on tax treaty characterization issues arising from e-commerce, and he also writes extensively on taxation of the digital economy. Ruth, Jean-Philippe, Kimberly, and Gary, we are very glad to have you all here. Before we begin, please note that we are very glad to take questions from the audience if time permits at the end. If you have a question, just please submit it through Zoom's chat function. Thank you all for joining us, and we are ready for our first question. Gary, what are digital service taxes and how does this approach to taxation of the digital economy differ from the existing approach to taxation?
All right, well, thank you, Hannah-Laura and Leif, for the kind introduction. First, sound check. You can hear me okay? Give me a thumbs up. Okay, super. All right, well, one would think that this question would be straightforward. What are the digital services taxes? But in fact, from some perspectives, this is a trick question because it depends on your point of view. Some people would regard digital services taxes as striking a blow for fair taxation and tax justice. Others consider digital services taxes to be a seriously destabilizing act in the international tax network because it is legitimizing countries' conscious efforts to avoid their international obligations under tax treaties and trade obligations. So how can a set of taxes result in such diametrically opposed views as to whether these are good taxes or bad taxes? That's essentially the topic that we'll get into during the course of this discussion. So let me outline just briefly what the digital service taxes are. They started really from a proposal by the European Commission for a directive that had as its ultimate result essentially a new PE, a significant digital presence. And the digital service tax was meant to be just a temporary stopgap measure to get from where we were in 2018 when the proposal was introduced to the new regime of significant digital presence. But all the air got sucked out of the room with the DST because that's what people wanted to talk about. That's what the governments pursued. And eventually, the DST proposal was set up for approval as a potential directive, but ultimately failed due to the lack of uniform support for the DST within the EU member nations. The DST is very simply stated a tax on gross revenue, so very different from our traditional income tax, which is imposed on net. And more importantly, it was focused in very particular ways. First, it was focused on particular revenue streams. The original DST, as proposed for a possible directive, was focused on three types of revenue streams. Generally speaking, digital advertising, payments to intermediary platforms that connected users on either side of the platform, and data transfers for consideration. So it was focused on a very narrow subset of the digital economy. And even more importantly, it was focused on enterprises of a certain size due to the imposition of thresholds. First, global revenue thresholds. Only enterprises with more than 750 million euro globally would be in scope, and national thresholds that in the original European version, revenue within the EU would need to exceed a certain scope. And as I'll mention, as the idea metastasized into separate country DSTs, okay, I think I lost connection there for a minute, but let me continue. Okay, so I'm back. And so the thresholds, there's a global threshold and then there's a local threshold. And the effect of this was to concentrate the tax almost exclusively on large American digital service providers, the so-called GAFA. And I think it's pretty transparent that the intention of the legislatures, both at the EU level and at the national level, was indeed to discriminate and impose taxes on this particular subset of companies. So that in summary, the way that these taxes are different from normal income taxes is they are based on gross, not net. Um, Generally speaking, they're not expected to result in tax credits in the state of the payor, and they're very consciously engineered to avoid tax treaty obligations, trade obligations, and other national obligations such as EU measures restricting taxation. So let me stop there. One more final thing. So after the EU did not succeed in getting the directive adopted through unanimous agreement by the members, several individual countries around the world took up the idea. France was the first mover with a national DST. It spread outside of Europe. There are now DST or DST-like taxes in many places. And as these taxes have spread around the world, they have lost some of their narrow-like focus on particular high-profile American digital service providers, with most recent example being the Indian equalization levy, which has a very broad scope, essentially applying to any online transaction. But I think the equalization levy is kind of the progeny of the digital service tax, because it is the result of the idea that, well, the digital economy is something new. There are a lot of players from outside the jurisdiction that are able to sell goods and services into the jurisdiction. So let's come up with a way to tax them. Digital services narrowly focused on a small subset of companies, equalization levy focused broadly, essentially on all online transactions. So Leif Hannelore, I think that's a very high level overview as to what the nature of the DST is.
Thank you, Gary, for introducing the topic of digital service tax. It's a very interesting topic, so, as you can see. But Jean-Philippe, can we ask you, what is the status of OECD talks addressing tech challenges from the digitalization of the economy? What would happen if these talks fail? And could you also maybe address a little bit about the status of the adoption of digital service taxes, both by individual nations and by the European Commission, as of today?
Yes, of course. First of all, hello, everyone. And of course, thank you, Liv and Hannelore, for this kind invitation. It's really a pleasure to be here on such an excellent panel. Let me start with creating some background and situating the issue. So the issue with the digital economy, of the digitized economy, is that actually the international tax principles agreed upon at the beginning of the previous century are actually no longer fit for purpose. In the meantime, especially the last decades, the world has changed, and the way how companies do business has as well changed. And because of globalization and technology, electronic communication, it is much easier to do business in countries without being physically present there, whereas under the OECD model convention as it stands today, the PE threshold, or being physically present, is actually the threshold for levying taxes. In addition, the value of IP and actually know-how has become much more important. And so the value increased significantly and is actually the key business driver for many companies. And the current the transfer pricing rule and PE rules actually make it possible to locate lots of your generate your profits in low tax jurisdiction. And there is so no longer broad consensus that the classical international tax rules produce appropriate outcomes. So this is well at the OECD, they recognize this issue. And when the BEPS project started in 2013, BEPS Action 1 focused on digital, which resulted in 2015 of BEPS Action 1 report addressing the tax challenges of the digital economy. In this report, actually, there was no agreement upon concrete measures, no concrete outcome yet. But afterwards, the talks continued. We had the publication of an interim report in 2018. Then in 2019, there was a proposal for a unified approach. which finally resulted in the publication of the OECD Pillar 1 and Pillar 2 blueprints in October 2020. And this is in a nutshell actually where we are today. So what is this Pillar 1 and Pillar 2 blueprint all about? Well, this Pillar 1 is really focusing on digital, and is the reallocation of taxing rights to market jurisdictions, and basically is about transfer pricing. So translating this to digital, this actually means more taxing rights for the country where the users are located. And so that's Pillar 1. And Pillar 2 is about the introduction of a minimum tax. It has, as such, less to do with digital. However, it's important that the OECD treats this Pillar 1 and Pillar 2 blueprint kind of as together. And there are some countries that say, well, we will only, there's either an agreement on both pillars, or there's either no agreement. So that's why it's important to know that there is, well, besides Pillar 1, something as Pillar 2, the introduction of a minimum tax. But well, for the sake of this this conference, let's focus on Pillar 1, which is about the reallocation of taxing rights to market jurisdictions. And actually, it is a reallocation to market jurisdictions without that there is a physical presence required. And this is in the Pillar 1 blueprint, the so-called Amount A. And one of the main issues, so there is the blueprints were published, there is no final agreement yet. And one of the main issues is actually the scope on which there is no agreement. And let's say there is one group of countries that want to have a narrow scope, focusing only on companies, on online advertising companies, on intermediation platforms, on social media platforms. I think you already know which companies that are and where they are located. And then there's another group of countries who made it very clear that one just cannot ring fence one type of group or category of companies. And of course, if we do something, change something, there needs a bit a more fundamental change, and a broader group of companies should be covered. And so this is a bit where we stand today from an OECD perspective. Now turning towards Europe, actually right after the publication of this blueprints, well, Europe was, well, we still do not have an agreement. We already had, as Gary mentioned, the proposal in 2018. We cannot keep on postponing. And they said, well, we will give you until the end of June 2021 until to reach an agreement. If not, we will move forward on our own. This is already expressed by the proposal in 2018, but as well to make this statement actually more clear, that's at least how I interpret it. At the beginning of January, the European Commission launched a public consultation for a digital levy. And if one looks at the questionnaire that goes along with this public consultation, you can see actually that the scope that that would cover this digital levy could be much broader actually than what is proposed under Pillar 1. For example, there is a question on which is the revenue threshold. We know from the Pillar 1 that is 750 million is a revenue threshold. If you look at this public consultation, there is a 500,000 euro threshold, which is of course much lower. There's as well a question on which activities should be covered. And this is as well much broader what you can see in the Pillar 1 blueprint. So the European Commission made it very clear that it would move forward on its own if no agreement is reached. On the other hand, they always express as well that they prefer to reach to come to an international consensus, that is still the preferred way to go. And in this regard, they mainly reached out to the US as well. They published a transatlantic agenda, for example, in December 2020. And they hope that under the Biden administration, they can come to an agreement on the international level. So it would be interesting to hear the US view on this. But maybe before that, I would like to mention one more point, and what's already mentioned by Gary as well. The longer these talks take, the more we see that countries as well in Europe, but as well outside Europe, take unilateral measures. And I think now today we have about 15 countries in Europe that either introduced a DST or that are planning to introduce a DST. And it's kind of every month you see a country coming up with a new proposal for a DST. So I think the longer it takes, the more we see this going forward. So yeah, this is it for me for now.
Thank you, Jean-Philippe, for introducing the highlights on the OECD level and the EU level. What is the stand of digital service taxes as of today? Kimberly, can maybe ask you, what is the Belgian government position on digital service taxes? Because you and I as well, we are both from Belgium. So it would be interesting to know what is the Belgian position, because we have a Belgian legal proposal to introduce the digital service tax. Is there a new evolution in implementing such a digital service tax on the national level? Can you talk a little bit more on this issue?
Hi, everyone. Can you hear me? Sound check test? Okay. First, thank you so much, Leif and Hannelore, for introducing me and for inviting me for this conference. For your question, no, there are no new developments. I think that Belgium will wait on the European DST, and Belgium will not introduce a national DST like France or Italy. The Belgian proposition of the national DST is likely a political maneuver, and it is clear that the COVID pandemic has increased the pressure on the Belgian government to find extra revenue. And the idea of increasing the effective tax rate of large digital companies is an idea that sells easy to the public, more so than extra taxes on personal income. But as the Belgian Council of State has pointed out, the current draft of the Belgian DST creates legal uncertainty, and there are still many legal obstacles, for example, with regard to the legally correct classification of the tax and so on. But I know my fellow panelists will speak about that more later.
Thank you, Kimberly. So if we move on, like we will talk a bit more. I think it's time to talk a little bit more on the readiness for digital transformation in the international tax landscape. And Leif, my colleague, will do this part.
Yes, thank you very much, Hannelore. And again, thank you to all of our panelists for being here today. Over the past 5 years, this issue has really taken off and taken the limelight in many circles in international taxation. And there's some barriers in the way that prevent this from getting to where it needs to be. One of those that we've seen really take over the world over the last year and a half is the COVID-19 pandemic. Professor Ruth Mason, I would really like to hear from you about how the pandemic has impacted the adoption of digital services taxes in Europe.
Sure. So first, let me say thank you for the invitation. I'm very impressed with the effort put together by the students in this conference, and I'm really happy to be here. Although I must say there's quite a lot of disappointment in Charlottesville over the departure of our wonderful colleague, Dana Matthew. So kudos to you at GW, but we miss your dean. Yes, so COVID has put a lot of pressure on public budgets. Governments are collecting less revenue, but spending more. They're spending on relief, they're spending on stimulus, they're spending on healthcare. And so this increases the pressure. The other noteworthy observation here is that the subjects of digital tax, the digital giants, are the companies that are suffering the least in COVID, and some of them are profiting greatly, right? So they're the very companies that have become difficult to tax due to our antiquated tax system are the ones that are making larger profits in this time when people are really limited in their ability to move physically. Just think about the platform that we're speaking on now, Zoom. So yes, COVID puts pressure on digital taxes.
Thank you very much, Professor Mason. That is a very interesting comment to hear about how the pandemic has been impacting Europe's pursuit of digital services taxes. I think that will continue to carry forward the longer the pandemic prolongs. Another hurdle that has come up with regards to Europe's adoption of digital services taxes has been U.S. Trade investigations into whether or not these taxes unreasonably or discriminatorily burden U.S. commerce. This comes under the U.S. Trade Representative's authority under Section 301 of the Trade Act of 1974. Gary, what is the status of this investigation, and does the new administration signal any shifts in the U.S.'s approach to this issue?
Well, Leif, let me start by commenting that this is a very unusual intersection of the tax law and the trade law. It's not unprecedented. People can remember that alleged export subsidies that the United States had imposed through the tax law in our FSC all the way back to DISC, FSC, ETI, ended up as WTO cases. What is different about the Section 301 sanction is that it is a unilateral action by the United States Trade Representative, as opposed to going through what we'd call the normal dispute resolution process of the WTO. 301 has not been used much by the United States in the past, but the past administration did consider it to be an important policy tool, most importantly with respect to the sanctions the United States imposed on China. So along comes the digital services taxes, and as noted, they were pretty patently intended to discriminate against U.S. companies, and so the USTR perked up his ears and launched investigations both into the French DST, which was the first to come online, and then subsequently into 10 other what he called DSTs, although some of them weren't really DST-like, like the Indian equalization levy, and concluded, first in the French case and then in several of the individual cases in the follow-on investigations, that those taxes are indeed unreasonable and discriminatory, unreasonable under many grounds, including that they depart from accepted norms of international taxation, discriminatory because they were designed to disproportionately impact U.S. companies, and burdened or restricted U.S. commerce by virtue of this new financial levy imposed disproportionately on U.S. companies. So 301 investigation has three different stages to it that people need to focus on. The first is the investigation to determine whether something, a foreign levy, is actionable. So that has now happened for France and several of the other countries like the UK, Spain, Italy. But that's only the first step. The second step is then to determine what sanctions could be taken. So that step has been taken for France, in that it was determined that up to 100% tariffs could be imposed on certain imports from France, including cosmetics and handbags. And one quite mightily question whether it really is appropriate response to tax imports of cosmetics if the problem is a foreign tax on digital, but that's a fundamental problem with the 301 sanction. And then in that it imposes the cost on U.S. consumers when the bad act being complained about is a tax levied on an entirely different population or a subsidy given to an entirely different population in the foreign country. Then the final act is actually imposing the sanctions, and that's where, Leif, your question really hits. because so far, the United States has not gone through with imposing the sanctions on France. There have been no hearings on what the possible sanctions might be for the other countries. And what the former USTR essentially did is kick it to the next administration. Sanctions were scheduled to go into force on French imports on December 6th, I think it was. But December 6th came and went, and USTR never published new custom schedules, and a few days later announced that they were going to let the Biden administration take care of it. So your question is, well, what's the Biden administration going to do? That, unfortunately, I don't know the answer to. The critical player is the new USTR, who has been nominated, but I don't believe she's been confirmed yet. So I personally just can't speculate what her views will be. We do know that the United States has signaled an intention to be a little more engaged on a multilateral basis rather than a unilateral basis than was the case in the prior administration. So you can take that communication for what it's worth. And you can also observe that Section 301 sanctions indeed are unusual in the history of American trade relations. So sometime in the next few weeks, Catherine Tai, the new USTR, will need to take a view on what to do. I do note that even though the United States suspended enforcing the sanctions, the foreign countries that imposed the DSTs did not suspend accruing or collecting the DSTs. American companies indeed are paying them as required, but it's going to have to be a wait and see. One constant, I believe, and this will affect more than just 301. This will affect the project at the OECD Inclusive Framework of getting to a multilateral agreement as to reshaping the contours of the international tax system. Is we have had consistently over time bilateral comments from Congress that ring fencing the digital economy and any tax system that discriminates against, that is designed to discriminate against U.S. companies, is something that the Congress does not find acceptable. And that will be an important point when many people hope in the middle of June or early July this year, a proposal is agreed as to whether that proposal will in fact become implemented around the world. Because from my perspective, no matter which of the various proposals on the table under Pillar 1 and Pillar 2 is adopted, it's going to take congressional action to get it implemented. So this process, the issues will come back to the Congress, and I don't think the Congress is going to change its view that taxes that are designed to discriminate against U.S. companies are things that do not please members of the Congress.
Thank you very much, Gary. The U.S. response to this moving forward is going to be fascinating. So we'll have to hang in there and see what happens under the new USTR. Professor Mason, I want to turn back to you for a few moments to ask, seeing that there are all of these different impediments that have come up from COVID-19 all the way through the US's action in response to European digital services taxes. What do you think? Is the international tax framework ready for a transfer to digital services taxation?
So I think that the countries need to change the international tax framework, and they need to do it in the hardest way possible by reallocating income among the states. So the digital taxes are frustrated responses to an outdated system that ties taxation to physicality. That's a tie that's allowed companies to avoid paying tax, even in places where they're very deeply enmeshed in the economies. Indeed, they're deeply enmeshed in people's day-to-day lives. But our tax rules just haven't kept up to date with those changes in the economy. Our tax rules were built for a brick and mortar world, and through obsolescence and inertia, we have found ourselves in a system that by default allocates, ends up distributing a larger share of the world tax take to the resident states of companies, larger than what was contemplated under the original agreement. And so some states understandably see that as unfair. The problem is what to do about that. Reslicing the pie is a zero-sum game, or nearly so. It's a very difficult distributional problem. And, I'll just conclude by saying that normally we decide these kinds of difficult distributional problems through voting, through democracy, and that is just not an option here. There we have negotiation instead.
Thank you very much. I'm going to turn it back over to my colleague Hannelore to discuss how digital services taxations are impacting both European nations as well as the US tech sector.
Thank you, Liv. So we know already that several EU countries already implemented initiatives to levy digital taxes on multinational companies. We touched already a bit on the legal proposals by the Belgian government, but could you elaborate a bit on the significance of digital service taxes to European nations? Jean-Philippe, could you address this question?
Yes, of course, Hannelore. So yeah, I said that. So we have about 15 countries. If I tried to did the count, and I came to 7 European countries that currently have a DST. That's Austria, France, Hungary, Italy, Poland, Spain, and then not forming part from the European Union, but still EU, Europe, Turkey, and the UK. And about 7 more announced they have plans to introduce a DST. Most of these DSTs follow actually the proposed directive of the European put forward by the European Commission in 2018. But of course, there are as well some differences. For example, the rate varies. So you have a 3% rate, for example, in France, Italy, whereas Turkey levies a 7.5% rate. You have as well different thresholds. For example, in France, you have a 25 million local threshold, whereas in Spain, they use a 3 million local revenue threshold. I think in general, generally speaking, the revenue impact, the budgetary impact for the countries of these DSTs is rather limited today. But especially if you compare it to personal income tax or VAT or so. But of course, it helps. It helps, every bit helps. Governments are in need of money. And of course, you can start introducing with a low rate, a narrow scope. And if you see it works, well, you just expand the scope or you levy a higher rate. And that's actually what India did. It's really significantly increased the scope there. So that is one point. I think as well, and it echoes a bit what has been told before in this panel. I think when you read about DSTs, or if you hear politicians talking about DSTs, well, it's easy to say, this multinationals, they're not paying their fair share of taxes. We are all suffering from this COVID crisis, and they're even making more profits. So let's tax them. I think this is a bit short-sighted, and I hope countries that introduced or plan to introduce a DST are building their case on more solid grounds, and they look at the economic aspects. For example, who actually bears the burden of a DST? Probably they pass it on to the consumer. So it's actually the consumers that might pay the DST. I think as well it can harm economies, because it's on gross revenue. So you have new companies who are maybe not yet profitable or only have a very low profit margin, if you then impose a DST, well, then you really harm economy. So I think there's this economic side. And of course, there are several legal aspects, as already mentioned. So what is the relation with trade treaties? What is European law you have there, as well the relationship with tax treaties? So I think this is something to consider as well when you want to introduce DST or have introduced DST. And maybe to summarize that, so I think in generally from a revenue perspective, currently not so important yet. But I think for companies, actually, for business, the more you see, there's more countries that adopt it. Of course, this adds, all these bits add up, and of course, so this has an impact. And I think as well the compliance burden. Imagine that that in Europe you have 20 countries introducing a DST. Well, then you have to comply with these rules in 20 countries, which is of course, yeah, as well has a significant impact for business.
Thank you, Jean-Philippe. So we see an increase of countries, especially in the EU, and Gary already mentioned the recent proposal in India, what has been implemented. And countries are increasing levying digital service tax. Gary, I want to ask a question to you, as you have a broad experience in the private sector as an American tax lawyer advising high-tech companies and multinationals. How does the adoption of digital service tax affect the US industries? And what has been the responses from these groups?
Well, I guess the principal response is to figure out whether your company is in scope, and if so, how best to comply. It really is a patchwork of the various taxes that Jean-Philippe mentioned. A few of them are on advertising only. The Austrian tax is advertising only. Hungary is advertising only, although I think they've set their rate to 0 for the time being. I think the Polish tax that has just been proposed is advertising only. So that's the narrowest scope. The traditional scope is still relatively narrow. Advertising, intermediary platforms, and data transfers. Someone at the beginning of the seminar referred to the platform we're on. I think telecommunications like this platform are out of scope. And if you're spending your time sitting at home consuming lots of online content, that's out of scope as well, even though that's pretty clearly an example of providing a digital service across border. If you get to taxes like the Turkish tax, they expanded their scope in a very ambiguous way, and then again, equalization levy with the most expansive scope. So the first question is, are you in or out of scope? So let's assume you are in scope. Then the next question is, well, how do you comply? How do you calculate the tax? One element that's very novel in these taxes, at least for the advertising leg, and I think for all 3 legs of the traditional advertising, intermediary platform, and sales of data. Normally we think of source of income as being where the market is, the payor. So if you asked a digital advertiser, how much revenue did you get from France, they could tell you. They know how much they invoice French advertisers. But that's not how these rules work. We'll take the French case as an example. The amount of taxable revenue allocated to France is a formula. So that in itself is very interesting. It's essentially a formula apportionment that takes global revenue. So not just revenue from the entity selling ads into France, but the global revenue of the entire enterprise, and allocate to France by a ratio that is the number of views of advertisements in France over the number of views of advertisements of every user in the world. And if you can imagine, these platforms being big enough to fall within scope because of the revenue thresholds, there are billions and billions of views of advertisements around the world. Companies are very conscious of their obligations to deal with consumer data in a way that's compliant with GDPR obligations in Europe, with California data privacy rules in California, my home jurisdiction. So the question for these companies is, how do we track how many users we have in India compared to how many users we have in France, preserve that information and make it available for audit for 5 years, and not be violating data privacy rules around the world. Companies typically aren't set up to track this sort of information. So I'd say the biggest impact on companies that are within scope is to figure out how to readjust their systems to, count all the users, all the viewers in India, count all the viewers in France, and run these formulas in order to apportion worldwide income to France. Once you've done all that, the compliance is relatively simple. It's done on a periodic basis. Some countries have made it simple, like a ESS VAT return. The hard part is getting to the number. The simple part is paying the tax.
Thank you, Gary, for the insights from the US private sector. They are very useful, and also for us as academia, specialists in the academia world. I think we will have a lot of food to write on the impact on US businesses in the future, in the upcoming months in particular. We see that actually to avoid that, countries will avoid digital service tax on a unilateral basis. I think it will be important what the US response will be on the new administration. After years of resistance by Trump administration, the EU and also many EU countries now hope that the incoming Biden administration will be willing to compromise a possible digital tax. But if we go back to the OECD proposals to implement a digital tax, Jean-Philippe touched already a bit on Pillar 1 and Pillar 2 from the OECD. Kimberly, you are researching the taxation of artificial intelligence in the framework of digital service tax. Can we ask you the question, how will income from artificial intelligence be affected by the OECD Pillar 1 and the EU digital service tax proposals?
Yes, thank you, Hannelore. This is a very interesting question because it's important to keep in mind that these proposals actually target the taxation of the digital sector in general, which of course includes businesses using AI. But these proposals do not target the taxation of AI and the income by AI itself. So Pillar 1 and the digital services tax are not a tax on the use of AI or a tax on AI as a separate taxpayer, as some European and even American researchers and politicians are proposing. The proposals of the European DST and the OECD Pillar 1 are about remedying tax evasion instead of remedying the effect AI might have on the labor market, which is, of course, a future national issue. Now, in which way will Pillar 1 capture the income out of AI? Well, Pillar 1 only captures income out of AI when the activity test is met, and this is very important. And it is, as Gary said, are you in or out of scope? So it is the same with income out of AI, which means that the income out of AI will only be targeted when it qualifies as an automated digital service or a consumer-facing business. Because of the broad scope of consumer-facing business, AI will be captured when the activity of the business is primarily focused on consumers. It is important to note that a good or service must be commonly sold to consumers. Whether or not the good or service is actually sold to a consumer or a business is irrelevant. And this is quite tricky, I think, because what goods or services are normally sold to consumers? Computers, software, cars, trucks. This guideline carries some uncertainty from my perspective, and maybe that in practice this will be interpreted differently, but it does feel a little arbitrary and opens up the possibility for abuse and evasion of the Pillar 1 rules. It is safe to say that a lot of businesses that use AI will fall under the definition of consumer-facing business, and so Pillar 1, as long as they sell a good or service that is, as long as it's about a good or a service that is commonly sold to consumers, whatever that is. As for the European Digital Services Tax, as mentioned by my fellow speakers, the European DST has quite a narrow scope. It only taxes income out of certain digital services and not all digital services. So the DST only envisions services in which a user plays a central role. Only when the AI system can be qualified as a digital service under the Digital Services Tax, it will be captured under the tax. So this proposal will not capture all the forms of artificial intelligence. For instance, the DST would not capture certain forms of AI that have a high potential to replace human labor. First, all the forms of AI that do not involve a user within the meaning of the DST will fall out of scope, like AI deployed in the retail sector, security sector, manufacturing sector, and so on. So since the DST has quite a narrow scope compared to all the domains where AI can be deployed, the effects will be limited.
Thank you, Kimberly, for the interesting insights from your PhD research. Now we are going to our next part. It's about the legality of digital service taxes, and Liv Anderson will address this question or these questions.
Yes, thank you very much, Hannelore. Obviously, we've talked a lot today about the different proposals that are being put forth, the response from the US tech sector, the rationales behind why these digital services taxes have been pursued. But one of the questions that would be really interesting to hear a response to from you, Professor Mason, is, are there obstacles, legally speaking, to the implementation of these taxes, either within the EU or internationally?
Okay, yeah. So as Gary talked about, there are definite trade law issues here. Let me talk about some issues that are lurking in EU law, and then for US states that have digital taxes, because EU countries and other countries in the world are not the only sort of states that are enacting digital taxes at the moment. So first, let me talk about EU law. So these EU digital taxes have these very high revenue thresholds, and then they focus on really narrow revenue streams. So Gary was mentioning earlier, you know, streaming content is not taxable by these digital services taxes, but one might imagine, right, if the reason that you're assessing this tax is because you want to capture income of companies that lack a physical presence, that you might want to tax streaming services. You might want to tax, for instance, Netflix. So, you know, looking at the taxable revenue streams, it's hard to offer an explanation for why the particular streams were chosen that were chosen. One provocative answer has been given is that had the EU, for example, chosen to tax streaming services, then Spotify would have been taxable, not just Netflix, right? And so this sort of goes to the narrative that what the European Commission was trying to do and what EU countries were trying to do is target US multinationals while leaving domestic EU companies untaxed. So, you know, there's a potential nationality discrimination issue there, that the high revenue thresholds mean that only the world's largest companies are subject to the tax at all. And that means almost entirely US companies. So when the US Trade Representative investigated the French tax, there were only about 20 companies in the world that would be liable for the tax, only one or two of which were French, and the rest of which were foreign to France, mostly US companies. So, you know, the law in Europe prevents nationality discrimination. Specifically, it's like the US Dormant Commerce Clause. It prevents states from discriminating against cross-EU commerce from other EU states. Now, you might say, well, That's not what the EU states are doing. They're discriminating against US companies. That should be fine. The problem is that US subsidiaries in Europe, right? So that, let's say the Irish subsidiary of Apple, right, or any other US multinational gets protection under EU law from the fundamental freedoms from these non-discrimination rules in Europe. So US companies are protected through their subsidiaries from nationality discrimination. You know, and then the other thing, as Gary said, you know, the protectionist intent of these rules was quite clear. The leaders were very clear that the goal was to tax US digital giants and to shelter EU startups. The Austrian example is particularly instructive. I don't know if this ended up being in the final law, but when they proposed it, that part of the tax would go to fund Austrian media companies. Okay, so you tax the US companies and you use the income to subsidize Austrian startups. An Austrian official bragged that no Austrian company would be subject to the Austrian digital tax. So, you know, that's potentially a legal problem. We have to wait and see what the Court of Justice of the European Union might say about it. All the early indications are that the Court of Justice would not be receptive to such an argument. We can talk about that in more detail later if there's time. For US taxes, so to the extent that the US, the ones passed by US states, like the one in Maryland, to the extent that they don't apply to goods and services that are provided outside the digital context, for example, print ads, then they may fall afoul of US domestic law, the Internet Tax Freedom Act, which prohibits that kind of sectoral discrimination between digital and non-digital. But there's also a possibility that they violate the Dormant Commerce Clause, which is our rule against discrimination. So to the extent that a tax like that recent Maryland tax disproportionately taxes non-Maryland firms, it could face a Dormant Commerce Clause problem. And you know, those non-Maryland firms could either be from other US states or they could be from foreign countries. And either of those is a problem under the Dormant Commerce Clause, which prevents discrimination against commerce coming from other US states, and it prevents discrimination from commerce coming from abroad. And then the dormant Foreign Commerce Clause problem, okay, as compared to the dormant interstate commerce problem, is potentially, that's a bigger obstacle because the Supreme Court has an extra gloss that applies for the dormant Foreign Commerce Clause that doesn't apply for the Interstate Commerce Clause, which is that states are not allowed to interfere with a federal government's ability to speak with one voice in foreign relations. And we know that the United States has strenuously objected to digital taxes abroad on the grounds that they constitute nationality discrimination. And arguably that argument is made harder when Maryland has a digital tax. So that's another potential problem for US taxes.
Thank you very much. Gary, it seems like you want to chime in.
Yeah, I do. If you don't mind me
Yeah,
jumping into on a point of the agenda where I don't have an assigned slot. But to Professor Mason's comment, yes, that subsidy element remained in the Austrian law. There are several of these taxes that do have the interesting element of being designated to support particular funds, local country funds of one sort or other. The Brazilian tax has that element. The Polish tax has that element. The Austrian one is just particularly notable because that fund is not just for the support of Austrian startups, it's for the support of Austrian media companies to enhance their digitalization. So it's essentially a tax on foreign media companies to support Austrian media companies, which I would think that would raise the hackles of many people. It's sort of like the United States somehow, imposing a tax on tickets, entry tickets to the Louvre in order to subsidize the San Francisco Museum of Fine Arts. I don't think that's what taxes are meant to be used for. I also wanted to, add to the comments that Professor Mason made about, the fundamental freedoms under EU law, that these taxes also are consciously designed in light of avoiding tax treaty obligations. When you look at it, it really is an interesting intellectual exercise to think through all the shoals that these taxes needed to navigate. It's not like a rock and a hard place or a Scylla and Charybdis, because there are multiple elements these taxes needed to navigate in order to become, legal, or maybe I should say not illegal. Not only, fundamental freedoms under EU law, they have to be not an income tax within the meaning of income tax treaties, because otherwise they could not be imposed without a PE. If you say, okay, well, they're not an income tax because they're a tax imposed with reference to consumption, they're more like an indirect tax. Well, in the EU, you can only have one VAT, so they can't be a VAT either. They can't be the type of tariff that is prohibited by WTO rules, a tax on services. So when you count it all up, it can't be violative of constitutional principles, such as the fundamental freedoms. It can't violate the only one VAT rule. It can't run afoul of tax treaties, and it can't be an illegal tariff. So if all of those are true, then these taxes are a new thing that we really haven't seen before. And my opening comment about whether you view these taxes as, a blow for tax justice or a very troublesome development, adherents like myself, obviously, of the view that this is a very troublesome development, is it doesn't seem to me to be a good thing for the international tax system for there to be a possibility for countries to devise a tax like this that is focused on a particular sector and doesn't have to be accountable under tax treaties, trade treaties, constitutional principles, et cetera, et cetera. It won't end at digital services. There will be other applications of this new type of tax somewhere else.
Thank you very much for that addition. It sounds like there's a lot of further barriers that this form of digital services tax regime may face moving forward. But from what we've heard and from the perspective of all of the European nations here, it seems like there is going to be something that happens moving forward in terms of changing the current regime that we have to potentially make it more fair. And what I would like to hear, and I'm going to pass it over to my colleague Hannelore, is to hear about, well, what's next? What's on the horizon? Hannelore, I'll turn it over to you.
Thank you, Lief. So it seems that digital service tax is alive and that there is no way out. Kimberly, I want to ask you a question about your research. Could a tax on artificial intelligence be a good idea?
It's important to stress out that the DST and the Pillar 1 are not specific taxes on AI. And to answer this question, I must first briefly explain why various researchers and politicians are proposing a tax on artificial intelligence and outlining the debate. So the proposals for a tax on AI fall into three broad categories: a submission to VAT, a tax on the use of AI, or a tax on AI as a separate taxpayer. Proposals for a specific tax on AI are mostly motivated by the fear that AI will take over various human jobs in corporations, thereby increasing unemployment. This risk has already been proven by various types of economic studies in the US and in Europe. The rise in unemployment would lead to the government receiving less revenue from taxes on labor, and this would lead to a significant decrease in government revenue since several countries get their revenue mainly from labor taxes. At the same time, the government spending will increase because the government will have to pay welfare benefits to all the people who lost their jobs to AI. Researchers also fear that in the long run, AI will become so autonomous. Think about science fiction, iRobot or Westworld, for instance. What if AI gets self-conscious? Then it would be a problem for natural and legal persons to assert any property rights over them. So the income generated by these AI systems will escape any form of taxation because of their lack of legal personhood. AI cannot be seen as a natural or legal person, and therefore it cannot be taxed in the personal or corporate income tax. For this assertion, some researchers propose a tax on AI as a separate taxpayer, much like the form of the corporate income tax. Now, back to the question if I think that a tax on AI would be a good way to go. Right now, no, a tax on AI would be not a good idea. The current characteristics of AI run parallel to the general risk of digitalization and tax now. Tax on AI would risk demotivating and thus slowing down innovation in AI and developments in the field of AI. In addition, a tax on AI would raise several difficult technical questions, especially for a tax system that is generally very anthropomorphic. But I do believe that a tax on AI would be a good idea in the long run when AI would be further developed. There are also several tax principles that argue for a tax on AI, like the ability to pay principle, the benefit principle, and the neutrality principle. So I believe that a future tax on AI should be seriously considered today.
Thank you, Kimberly. I am certain that you will have enough food for thought for your PhD on the taxation of artificial intelligence with the new and rapid evolutions in the digital service tax world and actions by the OECD and unilateral measures by EU countries, India, and also like if you see the state level taxes in the United States. Reed Mason, I want to ask you a question on if you have any suggestions for the best method to tax the digital economy. Like if you see what is next, what is the path forward? How should we proceed?
So I don't think you can put the genie back in the bottle. I think that the path forward ideally would involve cooperation rather than unilateralism, for all the reasons that the countries originally came to compromise and cooperate. That is, tax certainty and avoidance of double tax promote growth for everyone. The states compromise ideally would be durable, and so shouldn't focus over much on the problems of today while ignoring the problems of tomorrow, which we can't quite imagine yet. So it wouldn't be ideal if the states were to work out a compromise only to find themselves in exactly the same position 10 or 15 years down the road. The hard part, of course, is figuring out what to do. I tend to agree with the Americans that you can't cleave off the digital economy from the rest of the economy. But responding to other countries' legitimate complaints about the current distribution of revenue has to acknowledge that physical presence is not the talisman it once was. So to change the distribution without risking a solution that ends up just being a stopgap requires states to think beyond digital. I think it makes sense to think about market-based factors such as user inputs, but not to limit the consideration just to the digital sector. The other development that's really important here, I think, is minimum taxation, as JP said. So it's not exactly on digital, but it takes the pressure off of companies to shift their income, which can help on digital and everything else. So if they're sure to be taxed at some meaningful rate, no matter where they declare their profits, well, then maybe companies don't put as much effort into shifting their profits around, and you don't need stopgaps like digital tax. That said, I must say that digital taxes are convenient. They don't require bi or multilateral negotiations. They're popular with voters and therefore with politicians. I think the reason for that popularity is essentially based on a mistake. That is, politicians and voters imagine the burden of those taxes to be borne somehow by the companies themselves, which we know is impossible. But that makes those taxes very popular. So while I hope for meaningful and durable reform, I can also imagine digital taxes ending up being a compromise position if countries come to the conclusion that they can't reach a compromise on these bigger distributional issues.
Thank you, Professor Mason. Somebody wants to chime in? Or about, yeah, like what are yours individual thoughts about like what is the possible way to go forward?
Yeah, if I can hear, I think I fully agree with what Professor Mason said. I think we are really, I think the next 6 months will be, or like this year will be very important, and I think it would be really good if we come to an international agreement that can last for a long time. I think we really have now in a unique moment, and we have to let's hope that they make use of this momentum to really reach an agreement, because otherwise all these unilateral measures, I don't think anyone is really waiting for this.
Thank you, Jean-Philippe.
Yeah, I'll comment,
Yeah.
Hannah-Laura, if that's okay.
Perfect.
Yeah, from my perspective, the most important point is the one that Professor Mason made, that at the international level, what this should be about is an agreed reallocation of taxation rights with agreements on both sides. The countries that want to claim more taxation rights will stake out their claims, but countries that give up their taxation rights also need to, be comfortable that the deal is fair. The reason DSTs, in my view, are not appropriate taxes is because they're imposed on top of the existing framework, consciously designed to not be a creditable tax. Talk about, well, they're deductible. That's really neither here nor there, because the jurisdictions that impose the tax don't have companies that pay the tax. So saying it's a deductible business expense really is neither here nor there. And the issue about how best to allocate taxation rights, and including perhaps giving some recognition to market-based factors, that's what's happening now at the OECD level. And most digital companies hope that there will be a resolution at the OECD level that will result in taxation on net income, not gross, with effective double tax relief, and with an effective dispute prevention and resolution mechanism. Because under those circumstances, the system comes back into balance. It's always been an important part of the OECD inclusive framework work that balance would include withdrawal of all relevant unilateral measures. And from the perspective of U.S. digital companies, that really is a sine qua non of the inclusive framework result, that once the system is rebalanced, then there is no place for these on top free floating taxes. Thinking of how a tax on artificial intelligence would fit into that. So let's assume we get an agreement on amount A and amount B, and pillar 1 and pillar 2, and someone wants to propose a tax on artificial intelligence? Do they, then dig out all this great thinking that's been done around the DST and figure out a tax that doesn't violate tax treaties, doesn't violate trade treaties, is not a VAT, and doesn't violate the fundamental freedoms? I guess that illustrates my point that this line of thinking is one that's dangerous for the system and is not going to go away. I hope that governments do not think that taxes above and beyond the normal tax on particularly value creating activities like artificial intelligence is good tax policy.
Great. Thank you very much. This has been a very informative panel, and I want to thank all of you, Professor Mason, Jean-Philippe, Kimberly, and Gary for your time and for your input about the future and the current ongoing discussions around digital taxation. Thank you so much for being with us. And to everyone who has attended today, thank you very much for joining us and for engaging in this conversation with our panelists. This is going to be a very important issue moving forward, and for all the other students that are going into tax law fields, this is something that I'm sure you're going to have to confront at some point in the future. So next, I just want to make a plug-in for the next panel. We ask that if you have time, you can stick around and join the panel, which is entitled "Antitrust Regulation of Platform Gatekeepers: What's the Best Option?" This panel will begin at 1:30 p.m. Eastern on this same Zoom link. So stick around, get yourself something to drink, some popcorn, whatever, and please come back and join us. Thank you again to everyone, and have a great day.